Well, good afternoon, YouTube. This is Sean with WickQuidity. Today is February 19th. Sorry, I took a couple days off there. Went out of town and had some family time, so had to take a few days off. I apologize for not making a lot of videos here recently. So I wanted to dive right back into this. I've done the first two videos on the supply and demand course playlist that's on YouTube here. So now we're going to get into more of the intermediate kind of stuff regarding supply and demand. Trying to keep these videos relatively short, but still informative. I know the first two were very, very basic. I'm going to try to get into a little more intermediate type knowledge as it comes to supply and demand through this video, and go over a little bit more meaty stuff. If we can get through enough fast enough, as we go into the next lesson or two, it'll be more of the advanced stuff. We'll just see how this goes as we get through this video. So firstly, here's a chart. This is a 1 hour chart on gold. This is a nice clean chart as far as structure goes. It plays out really nice. Not all instruments will look like this all the time. So you've got to kind of find how you see the market and find instruments that you can trade on time frames that make sense for you, that give you a picture that you can read, if that all makes sense. You don't have to be beholden to one time frame or one set of time frames because somebody else said so. The market is very fractal. It doesn't matter whether you're trading the daily, the weekly, the 4 hour, the 5 minute, the 30-second chart. Doesn't matter. What matters is the methodology. Somebody's going to tell you that 4 hour signals are better than 15-minute stuff, and that's just not accurate. Now, in context, if you're trying to buy a 15-minute setup, whether it's supply and demand or whatever, that's inside of a 4 hour sale setup, then yes, the 4 hour, in theory, more than likely wins that battle. But you're going to get far less 4 hour setups, and if you play those out over time, in my experience with my own back testing, the win rates are basically the same. So I don't buy into the time frame bias. The time frame is up to you and what your schedule is. Okay, and then maybe if you're trading with a prop firm or something like that has restrictions on when you can trade, you may need to think about that as well. Like I know Top Step was futures. I use them as my prop firm, and I have to be out of trades. Like it's a literal day trading platform. There's no carrying trades overnight, over the weekend, things of that nature. So I have to make sure I trade time frames and I'm comfortable with my trades being done in a day. So that's one of the reasons I trade lower time frames. But it has nothing to do with whether the supply and demand zones or the methodology works on other time frames. It absolutely does. All right, real quick. So last video we talked about drawing supply and demand zones, and that demand zones were at the bottom of price, supply zones were at the top of price, and basically it's where the move starts, right? So this little move, you get this little consolidation period, nice move. You got this little stop consolidation period here, didn't draw the box very well, and price moves out of it. Not saying that's a great zone, just saying you can qualify that as a demand zone. Here you got this little consolidation area at the bottom, a lot of green candles coming out, price returns, rejects. Right? So, and obviously it's the opposite. For a supply zone, you can go here and you can go here. It's really simply the last candle or group of candles that usually the opposite color candle. I'll say candle color because you guys, it's the opposite direction candle from the move, right? So here we have a nice down move. So you could say I want this very last little one candle here. Some people do that. Some people will take the whole range as far as they'll take however many green candles it was. Some people include wicks. Some people include only one side of one wick, like the far side wick. So in this cell setup, a lot of people, any of the, like if they were just counting this one little candle here at the front, they wouldn't count the bottom wick because this is a cell, but they would count the top wick. So a lot of ideas on how to draw the zones. Big thing is how are you going to enter, right? So for me and my methodology, I'm going to assume you guys are going to trade my methodology. We use a lower time frame entry method, right? So it doesn't matter to me. Matter of fact, I prefer my zone to be a little bigger because I'm going to wait on price action on that lower time frame to confirm me getting in the trade. So just to get into a little bit of more refined drawing techniques. So in a move like this, where you got all this consolidation right here at the top, I probably would take that whole chunk there. Right? That would be my style of drawing a zone. And I get that from a couple different ways, right? These two green candles, even though it's kind of reverse, are about the same size as this red candle. So that's like one move up, one move down. Then this green candle, and this green candle are all essentially inside bars of the red candle. So that tells me that whole zone, that whole consolidation period, is something I'm interested in. I also could draw it like that, and it wouldn't bother me. But most likely this specific zone, I would have drawn like that in real time. Because you have the consolidation, the rotation in price, you've got the rally, the base, and the drop, right? Remember those terms. They're a little bit more kind of older school terms, but they matter. You got rally, base, rally, base, drop, base, drop, and drop, base, rally. All that is just ways to describe the four ways the market can create a supply and demand zone. So here you have a drop, and you have a rally, base, rally. Now this is a big base. Lots of rotation in price here. If I was interested in this section of price as a demand zone, I would go up a time frame and see if I couldn't find a cleaner look to try to get this in at like 2 to 5 candle range, 6 candles versus 15, 20, 30 candles, whatever that is. Make it look something like this section on a higher time frame. When you get clean zones, they're a little easier to draw sometimes, right? You get, so here's another like zone that has 4 or 5 candles. Let me see if I can find here's one. It doesn't play out, but you get one down candle, and then it reverses. You get the drop base is 2 candles. You got a red candle, then a green candle, then rally. This is how I would draw a single candle zone. If it's a good size, an average size candle like this, that's not an inside bar of the previous candle, things of that nature, I'll just take the one opposite candle. Now, obviously, this zone doesn't end up playing out over here to the right. We just crash through it. But again, that's why it's important that you for my methodology that we use those lower time frame entry methods. And we'll go through all that in time. Now, as we continue to look at these zones, we've got to kind of qualify them as to what makes them a good zone. Because there's, like I said, I think in my second video, you can get really fractal when it comes to drawing supply and demand zones, or order blocks, if you want to use that term. I mean, you could kind of say this is this green candle here because it pulls back. It does make a low. You could say this candle here, right? This green candle here, you could call a order block or supply and demand zone. And in theory, it's not inaccurate. It's not wrong. So what you need to do is come up with a system to identify which zones you're interested in trading out of. I do this a couple ways. One is I use a higher time frame trend. So now this is a 1 hour chart. So I don't typically trade on the 1 hour chart as an entry model. The 1 hour chart is typically my higher time frame. But if I was looking to trade the 1 hour supply and demand zones, I would use a 12 hour or maybe even a daily chart as my higher time frame trend. And I only trade zones in that direction. So that's my first filter. The next filter is, what does the zone do when it leaves the zone, right? It needs to leave it with momentum. It needs to leave it, and it needs to break some sort of structure. Those are two important things, right? So here you have a zone, and it leaves with decent momentum with the first candle, but you got all these topside wicks. It kind of stalls out and then finally breaks structure. So, but in doing so, it creates what you could draw as another zone here. Now, in this particular situation, you could say this zone played out because price touched it and reversed. I don't like this zone. Why don't I like this zone? Because when we came out of the zone, we had one little candle that did kind of break some previous structure. It made a high right here in this kind of micro structure and then broke this previous high. But then it consolidated, and then even the moves up were kind of slow and, barely grinding. This isn't a zone I would have liked to trade, right? You could take something like this one. Although I think it's much better than the last one. You got a nice red candle. You got green, 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 green. You got 4, 5, 6, 8 green candles in a row. And finally you get some momentum as you get toward the top of that. So it's a much, much better situation in my mind than the first two, even though it doesn't, quite play out. Then you get to this zone. Now, we're not done with this zone as far as what the reaction may be. And again, I'm just talking just the quality of what the zone does here, guys. I'm not even including the higher time frame perspective on this. But you look at this zone, and man, look at this. We get our little rotation in price, our consolidation, and then we just get a breakdown. Nice red candle, huge red candle, huge red candle, boom, boom, boom. Now I'm sure this was, this was a big dump by banks, institutions. This is nothing that retailers could have come close to doing in the market. So now this becomes a zone I'm highly interested in. So not only did we get huge moves, we broke multiple levels of structure, right? Multiple levels of structure. Didn't quite break the low here. But we also, broke trend lines that people draw. I also look at, nice trend lines that are really clean as forms of structure when it comes to structure breaking. Um, I can include that as well as the typical horizontal, support resistance traditional structure. So here I look at this move and I say, man, that's a move. So if based on my higher time frame trend, if this is a short I'm willing to take, this is a zone I'm highly interested in. Way more so than either of these zones. Can you see the difference in the movement? I mean, it's obvious, right? Um, this is the kind of stuff you want to be marking up. You also, we'll come back a little more. Let's see if we can find the one I was looking at a minute ago. Here. Not nearly as big a move, but you can see it's just as clean. Right? So we're in an uptrend. We do make one like little lower high here, or lower low here. And this is where the concept of liquidity sweeps really come into play. Um, this one break of this little structures here don't, in my mind, don't tell me a trend change yet. It could be the start of it, but I have some very specific rules on when the close and break of structure identifies a trend change. So at this point, my brain is still thinking long based on this chart. And then we have the drop, the base, and then we have this nice huge candle here with a fair value gap coming out of it. Fair value gap's a simple concept. It just basically means a big candle that isn't enclosed on either side by wicks with the other candles. Just means there's a lot of imbalance. It was a big candle with probably very few opposing orders on the way up or on the way down. Let's scroll in. All right, so fair value gaps are tradable themselves. I rarely trade fair value gaps, but this is one that probably would have played out if you believe in trading fair value gaps. You got a nice little setup there that you probably could have gotten. There are a few situations where I will, but that's a video for another day. So what did this zone accomplish? Let's look at that. We broke this structure very cleanly. We broke a 3-touch trend line very cleanly, very strongly. And then we went on to clear out this structure. This structure. I mean, this little zone, although it's not as big in size as this big red zone that we looked at a second ago. It's not as many ticks or pips or whatever, depending on what you're trading. It accomplished just as much in regards to breaking structure, breaking multiple levels of structure, breaking trend line / momentum line structure. And it also has another confluence that I like. Is it started, not this zone here, but the move here that started this correction, or that started this new leg, kind of started with a liquidity sweep. Liquidity sweeps are a very important concept because that is really the banks, the footprints of the banks and institutions, even more so than the supply and demand zones. Supply and demand zones are the easy way to identify the areas that were interest along the way, but the liquidity sweeps are really what tell you that the greater move, the trend up from here up, is in play now. We're done with this downward correction. And we're back into an overall long-term direction. based on that individual time frame, if that makes sense. So having a clear liquidity sweep right before zone, supplier demand zone. And in theory, you could have drawn this box out here. It didn't accomplish much, but this red candle here, I mean, you did have a pullback and up, a pullback. I'm going to break it out, little tiny structure there. That doesn't do it for me in my mind. But knowing that they were still near where this liquidity sweep happened, and we have formed a demand zone just after a clear liquidity sweep, and when that demand zone accomplished something that massive, I'm very interested in this zone. And as you can see, when price does pull back to it, it rejects and just goes to the moon, right? There are a couple things I don't like about this as price plays out. I don't like that when that price kind of structured back down into the zone. So you have at your high, boom, low, high, low. I don't like this. So this is a trade I actually took based on my lower time frame. But what I did is I was pretty conservative. I think I got in. I think it ended up being about right there. And then I always put my stop losses a couple ticks under the low. And on this particular trade, I traded it to the bottom side of that, assuming this is a new supply zone that could be reacted off of because we made a structure low. If this had just collapsed, kind of like this red zone collapsed, because you could have had this drawn out as a supply and demand zone, or as a demand zone on this side. If it collapses like that, I always trade back to the high. Right? In this case, it didn't collapse like that. It's structured down to it. So when it structures down to my zone, I always trade to the most recent high. And here you go. Boom. Yes, I'm going to get less, but this is still a really great trade at a 5.5, 5.6 to 1. That's one of my better trades as far as risk reward goes. I've said this multiple times. I'm typically in the 1.5 to 2.5 range. So actually, I don't think I got 5. I think I got 4.5 on this one. So I think I was right there getting in. So I got a 4.5 R on this trade, and just using some basic things. Also, one other thing I did like, now I would have took the trade either way, is I did like this little bit of structure here. Right? And I know I said I don't like price to structure down into my zone like here, but this didn't come into the zone. So then it started structuring back up. And what this did is this created a liquidity pool where people started to go long again, for this to come back and take out that liquidity and hit the zone and give me a lower time frame entry signal. So I knew in my mind that this was probably going to be a much stronger reaction than here. But I like to trade safe. I like to trade in a method that keeps my win rate high so that it keeps my mental health good. And again, that is a struggle that every trader will go through. I've said this on almost every video now, and I can't overemphasize this. You got to figure out, even amongst my methodology, what's good for you as far as win rate versus risk reward. I know I can be more profitable trading higher risk rewards. If I quit taking the 1.5s and I make my minimum 2.5 or something like that, I know I can make more money long term. But those couple extra losses are really bad for me mentally. And this was a big turning point for me in my trading, is understanding that I can't be the person that has to get 10-to-1 risk rewards on a regular, right? That can't be my normal goal, because that's going to give you, a 30% win rate, or maybe a little higher. But the constant losses that you rack up on a 30% win rate, even though you can risk incredibly low money, in my mind, it just doesn't work. So you have to find a strategy and a money management system that works for you. If you can trade 10-to-1, great. You can trade this system 10-to-1. Are you going to win as many trades? Absolutely not. You'll probably make more money than me long term, but you're not going to win as many trades. So you've got to decide that. I've got multiple trades put out on my Facebook and things of that nature, and I think I've got one or two of them on little short videos here on YouTube showing to where, man, I mean, if you really wanted to take, I mean, this trade give you 30-to-1 if you're brave enough to hold it that long. I'm not, but if you're brave enough to hold it that long, it's there. If you want to go to some, in gold, we're getting into some all-time highs, so there's not a lot of structure to look left to. And that's another thing is why I'm fairly conservative when I trade gold. Is it's tough to look for me. And I know some of you guys use fibs and things of that nature, but it's tough for me to find good trading points or good, exit targets once we're in kind of all-time high territory. So again, I traded this one really conservative. Ended up with that 4.5R. Hey, really happy with that. Really, really happy. So we talked a little bit about, price needs to be a large move. You really want this move to be from the zone to the top of the move before it comes back. You really want some distance, because remember, you're going to be trading back to a high. And so you want to be able to get good R to R. All right. And you want it to accelerate. You want big candles relative to the rest of price. Okay? So here we had one huge candle relative to the rest of the price that's around there. And we achieved all the structure breaks within just a couple candles of leaving the zone. So if you want to count this as candle 1, 2, candle 3 did work. We took a pause. Candle 4 really solidified the close above this structure. A couple more candles. So we made a huge move in a relatively short number of candles. That matters. The fair value gaps. I know there's a lot of stuff going on with the ICT trading stuff where people are really focusing on fair value gaps. Identifying the fair value gaps for me, again, mostly not a trading opportunity, mostly just me being able to identify that this candle left with good imbalance. Okay. And the fact that this one was formed with a clear liquidity sweep, or just after a clear liquidity sweep, just gives me all the confidence in the world that this zone was going to play out. And again, using the even lower time frame entry method that I'll teach when we get to that point, made this a great trading opportunity. So you take all of those little things. So we need a break, because we need large moves. We need break of structure. We would like to have liquidity sweeps right before or as part of the move. So let's say this little pullback right here never happened. Let's just say this thing just shot out of here, or from down here it just went straight up. The liquidity would have been the liquidity sweep forming the move directly. Either one of those would have been fine. We didn't necessarily need this little structure here before. it could have just come down, made this red candle here, and then just shot up as well, and that would have been a perfectly valid reason to put draw this zone out. Kind of hard to say in hindsight. We don't know where price would have been based on where the orders would have been for that to happen, but it would have been a valid zone nonetheless. So the zone forming as part of the liquidity sweep or just after the liquidity sweep, going back into the direction of the higher time frame trend, I mean, you've got every reason in the world. Those are the things we're really looking for. Okay, so let me put that in text real quick, and then we will try to end this video. So let me make this thing bigger. So one, you need a large move with imbalance or an FVG. All right. You need a break of structure. One, three. You prefer zone created sweep trading with the higher time frame trend. And then we also prefer a clean return to zone. Little to no structure, like returning to the zone, not necessarily going away from the zone. Right, so our start of our zone, we're cool if it structures up. But when it decides to make that move, we want the cleanest move possible. If this zone here, if this structure here had been low enough, like if it had pulled down to like here, barely come up and then come down, I probably wouldn't have taken that trade, because when we do have structure down, I'm typically trading to the most conservative structure. And if it doesn't give me a good enough R to R, I just won't take the trade. Right, so we prefer it to do this. We prefer to have a zone drawn out here and then price to collapse or explode. Even this going back up is pretty clean, right? You got this little sideways stuff here, and that's not even clean structure as far as highs and lows. So I would be interested in taking that short based on that. So there you have it, guys. Kind of 5 key things to look for when identifying if it's a zone that you want to trade out of. None of these things are necessarily more valuable than the other. They're all equally highly important. Hope that helps, guys. I'm gonna review this video, kind of see where I feel like we are, and I may make another intermediate video as well before we get into a little more advanced stuff. When I get into the advanced, there's probably only going to be one video for advanced, maybe 2, but I'm gonna try to keep it to 1, and then we're going to go into the liquidity series, because that is so important. Or I may even start the liquidity series first, because they kind of tie hand in hand as you get into the advanced stuff. So we'll do a little more thoughtful, a little more thinking on that, and kind of make a decision on how we want to go from there. Guys, really appreciate you watching the video. Please like, subscribe, all that good stuff. Trying to build a channel and offer you guys a bunch of information, a bunch of training to hopefully turn you into a full-time profitable trader as well. Y'all have a wonderful day.